Okay. I hear you ask, how much are companies worth, and why does the investor bro always end up in crippling debt despite having $1 million in the bank? Well, I'm glad you asked. Now, there is no honest way to figure out the net worth of a company. Only Elon Musk knows what the exact situation in Tesla is like. However, there are many tools we are given to understand them. The first is the stock price itself. Stocks, as said in my What Are Stocks video, go watch that when you're done, are shares of companies. Well, if you have all the shares, then you know how much the company is worth. You can actually figure this out. Most companies publish the amount of shares available. For example, Amazon has 508.72 million shares outstanding. As of May 25th, 2022, the current price is $2,114. So multiply it out and you get an approximate net worth of $1.1 trillion. Now, this is not perfectly accurate to the state of a business. For example, if we wanted to figure out the growth of Amazon since a year ago, we could take the stock price of a year ago and subtract it from the current price. However, the price a year ago was $3,223. This means that according to our calculations, the Amazon business has shrunk by approximately one third. Now, that seems highly unlikely for a business to close one third of itself and cause no stir, especially one as big as Amazon. So, how do you tell the performance of a business? Well, these neat things called financial statements. Financial statements are status updates on a company. They, unless they want to see the SEC knock on their door, are required by law to publish their financial information to the public. As such, they submit quarterly statements or every 3 months and yearly statements. Well, yearly. This comes in the form of income statements, balance sheets, and statements of cash flows. These three forms all indicate different things. Income statements indicate how much money a company has made in a time span. For example, if my restaurant sold 50,000 burgers, which cost $30,000 to make and had a $10,000 a year in rental costs, this is what my income statement would look like. As you can see, we start with the gross profit, talked about last video, and then follow it up with other costs. After subtracting tax, we are finally left with the true income of the business. Now, this is a very accurate picture of the capital a business has recently acquired. Capital, not cash. One problem with this model is that it does not account for non-cash income and expenses. For example, if you purchase something at a store on credit, no cash has entered the business pockets until you pay the cash back. However, your purchase is still marked as income. So how do you really tell which form you use to measure the cash in a business? Exactly, the statement of cash flows. The statement of cash flows represents adjustments to the actual cash balance of the business. This provides insight into three types of cash flow categories: operating, investing, and financing. Operating refers to cash in regards to the operation of the business itself. Investing refers to activities expected to grow the business in the future and would not be marked as expenses on the income statement. Finally, financing activities refers to activities such as stock sales, dividend payouts, and other activities regarding the finances of a company. Now, these are measured as inflows or outflows of cash. An outflow of cash is not necessarily a bad thing, as it could represent a company making new investments. However, the statement of cash flows and income statements do not sufficiently describe the state of a business. There is one missing piece. Balance sheets. Balance sheets effectively measure the balance between business assets and liabilities. Assets refer to cash, merchandise, inventory, equipment, and other things that are a net positive on the business. Liabilities measure things like debt, mortgage payments, and other things that are a net negative to the business. The difference between the two is known as equity. Equity refers to the stake owners have in the company. This refers to stuff like stocks and retained earnings. As such, the formula to figure these out is assets equals liability plus equity. It's common sense, but people like formulas, so here you go. Balance sheets demonstrate the overall health of a business. If a business has too much debt to handle, the income statement or statement of cash flows won't tell you that. However, all three of these statements are needed to judge the health of a business. So where can you find these forms? Well, you can just literally Google it. Google company investor relations to find the forms. Additionally, these companies are required to submit a 10Q, which is a document detailing their plans for the future, in words rather than numbers. Additionally, Google, Yahoo, and other sites can simplify these forms into more readable formats. Let's take a look at a pretend financial statements for a company I made up. So let's start with an income statement. The first thing you see here for company is the total sales revenue. Now, as you see, it's grown from 8 million to 10 million in the year. Now, cost of goods have increased from 4 million to 5 million. Now, as a result, the net increase in gross profit is 1 million between the years. There are some other things in this image you can figure out about the business. For example, how could you figure out if product is more expensive now than last year? I'll give you 5 seconds. You could like and sub now. Psych, you only get 4, unless you liked, subscribed, and commented a question. Then, thank you, you still get 4. First, divide the gross profit by the total revenue. Then, you can see the amount of percent change in the cost of goods. As you can see here, it has not changed at all, meaning that the company only earned more sales revenue and did not substantially decrease production costs. You can make inferences like this to figure out the status and performance of a business. This is a company's statement of cash flows. You can see each section listed here. There's not too much to see here other than that certain things such as income on credit or depreciation expense is covered. Cash flows are reliant on income statements, so you just need to work with the two. Finally, this is a company's balance sheet. You can see here that it has reduced its overall debt and liabilities while increasing its assets. As such, the equity of this company is growing. This usually indicates a healthy business. You can figure out its debt to equity ratio to see if the owners have a good equity stake in the business. A good number for the ratio is about 2, where 66% of the assets come from debt and 33% from equity. These can be used to determine the health of a business. In summary, companies are actually not really secretive things, at least public companies. Private ones absolutely are. I have no clue what's going on in them. You can figure out the true health of a company simply by analyzing these things. First, check the stock price to see the actual value of the company. Then, compare it to the financial statements the company publishes, income statements, balance sheets, and statements of cash flows. Each of these serve a different purpose but give a clear and concise picture of a company, and it is your job to make sure it is safe. Thank you for watching. Like, sub, comment, empty the dishes, drink water, and peace.